Break-even analysis is subject, perhaps, I don't know whether introduced for the first time after schooling, right? So what happens here? Now, as part of the operation level case study, operation level of CIMA, you are doing now P1, this chapter 11, right? So
Yes, ma'am.
what did we look in? We looked into the costing systems, and then we looked at budgeting, forecasting, managing, say decision making, short-term decision making. So as a finance officer, which is operation level, you will be looking more into the operational aspects. One important concept would be break even. That is, when are you breaking even? Break even is a point when there's no loss and no profit,
Yeah.
right? So a simple way of explaining it is, let's say you are doing some kind of a trading business.
Yeah.
You kind of like some decorative, pieces, and you have a unique shop. Like, when you go abroad, you have dollar store, pound store, everything is $1 or £1 or whatever, like that. Same way you have a store where you buy things at, say, $1.20 each unit, okay, and sell them at 50, thereby creating a margin of 30
Yeah.
per unit. Now you also have to meet additional monthly cost of salaries and perhaps rent, um, all these expenses you have to meet from this business. Maybe you've employed somebody, and maybe you need to make about, let's say, 15,000 per month to make the monthly payments, right? So
Yeah.
instruct your staff that, listen, don't take the money out. When you get this margin, deposit the entire 30 in some kind of a box, all 30s, okay? Everything that you get. You're buying for 20, selling for 50, getting a margin, deposit the 30s in a box. And once it reaches the level of 15,000, then is when we will be comfortable, because we would have the amount required for our, what do you call, for
Break
making
it.
a monthly payment. Yeah. Okay,
Yeah.
just one moment. I'll have to just stop the recording, I guess. Not sure. Pause recording now. Understand, right? So
Yeah.
we have this margin, and this margin is not touched till you get this amount. So how many units should you sell before you can make 15,000? Because you're getting per unit 30 margin, but you need 15,000 margin. How
You have
many
to
units
divide it.
you should divide?
Um,
Okay.
it's 500. 500, no, ma'am.
500. Okay, 500.
Yeah.
Okay. So at the 500 unit, what happens is you made your 15,000. And then now you tell the shop, your staff that, listen, we have sold 500, we have made our 15,000. Even if one more is sold, right? That
Yeah.
30 will be a profit for me. So you can deposit that in my bank account.
Yes, ma'am. Definitely.
Yeah, right. So let's say in the month 1,200 is sold, which means up to 500 was a break-even point, and the 700
700 will be profit.
into 30 will be profit.
Into, yeah. Into.
30, right? So here what I've done is, without telling you, I've created the formula for break-even point, which is fixed cost. See here, fixed cost divided by the margin per unit, or a contribution per unit.
Which is the fixed cost, ma'am, here?
15,000, because you're paying monthly,
15,000. Okay.
right?
Yeah.
Correct.
Contribution.
Yeah, contribution. 15,000 is a fixed cost divided by the margin. Margin is also known as contribution.
Contribution, ma'am. Yes.
Because the margin first contributes to the fixed cost, if you noticed.
Yes,
And
ma'am.
beyond the fixed cost is what the profits are occurring. That's it contributes. That's a contribution, right?
Yeah.
So now you have this 500, and the existing sales is say 1,200, which means there's a margin of safety. From 500 onwards, you've gone up to 1,200. So safety is 700. So
Yeah.
to know the current profit, you just do the margin of safety and multiply by the contribution per unit. Correct.
Yes, ma'am.
This gives you all those formulae. Now, why is break-even important? It's good to break even faster and earlier, because the less number of units you sell, you're safe, that you have got the money now for making the payment for fixed cost, right? Here,
Yeah.
with 500 units, you're able to make up your fixed cost. And a company which is doing 1,200 is comfortable. Even if sales were to fall to 1,100, 1,000 or 900, 600, they're still safe, right? And once you already have current sales of 1,200 with a profit that you're making of 700 into 30, which is equal to 21,000, right?
21,000.
Yeah, and 21,000 you're taking home, you're comfortable. Now, if you are getting a new order beyond 1,200, let's say in a foreign country, for example,
Yeah. Okay.
getting a foreign order and you want to expand your market. Why do you want to expand? Because there may be saturation in your country, right?
Hmm.
Then you can think of selling at a lower than 50. Yes or no?
Ma'am, wouldn't we want to sell it higher because we want to earn higher profits?
Yeah, but the market is not there. You want to enter into new country. So
Okay.
your way of entering would be through price slashing. How does China enter India, tell me, right?
Cheaper. Yeah.
Yeah. How do we enter for outsourcing to various countries? We're cheaper, right?
Okay. So when we enter a little cheaper, but once we start growing, we tend to
If
increase the
yeah,
price.
if the competition is it's if there is a market for your product with no competition, then you would, right?
Like Apple, ma'am. So
Yeah, yeah,
because
absolutely. Apple can increase the price,
yeah.
whereas other phone companies have to struggle, right?
Hmm.
Now, we are looking at a single product break even. We can also look at multi-product because they want to know the product mixes. How would we mix up the product so that, or at what point of sale of these products, given the products are being sold at a particular proportion, which is not realistic. Pant company is selling pant, shirts, and leather wallets.
Yeah.
Okay. So for every 10 shirts sold, you must be selling one leather wallet and maybe two pants. That must be the ratio. 1:2:10, you know.
Hmm.
So we have to assume that if the entire sales is happening the same similar ratio, at what point of how many packets of 1:2:10 or how many multiples of 1:2:10 will we break even? It's a different
Okay.
concept. But right now, simple break-even analysis is about this, right?
Okay.
We are looking at what is the break-even, the definition, the formula. So fixed cost divided by contribution per unit is
Contribution margin.
in point in number of units. Yeah. And if you want to know the profit, then you take the margin of safety, which is the current sales minus the break-even sales multiplied by the contribution per unit. You'll get the margin of safety, right? So
Hmm.
let's go down to the next page.
Yeah. Give me a second, ma'am.
Yeah. So we also call it as cost volume profit analysis because you see, finally, ultimately, profit, if you take cost, you take volume, profit will definitely be a function of the volume also because the cost has two components, variable and fixed. So after the variable cost is done, you have what's called as the fixed cost,
Yeah.
still to be taken care of. Correct. You still have the fixed cost to be taken care of, and that will only come through absorption of that will come through volume only, like you did the absorption costing. You need
Hmm.
to have sufficient volume. Only then it will cover the fixed cost, right?
Yes, ma'am.
Yeah. So this is also called a CVP analysis. In fact, the formula for break-even in dollar, break-even point in units I told you about. So break-even point in units is equal to fixed cost divided by contribution per unit.
Margin per unit.
Yeah, unit. And then if it is going to be break-even point in dollars,
You have to
if
multiply, no, ma'am.
no, it'll change a bit. Fixed cost divided by contribution to sales ratio, which is in our case, let's find out. Break-even point, we could do the formula 15,000, the first formula, correct? divided by
Yeah.
30 and we get 500. We get 500, right? Now, if I do CS ratio, contribution to sales, contribution is 30 and the sales is 50. So the contribution to sales ratio is for 40%, 0.4. Yes, this point,
Mm.
0.6, 0.6, right? Contribution 30 to sales, CS ratio, contribution to sales ratio.
Yes, ma'am.
So 60%. So I'll take fixed cost by CS ratio. Fixed cost is 15,000. CS ratio is 0.6. The value is how much now? 15,000 divided by 0.6 comes to how much? You can use a calculator.
Yes, ma'am. Give me a sec. 25,000.
25,000. And if you want to check, cross-check it, 25,000, right? Cross-check it at 500 units, selling
Mm.
at 50, 50 into 500 is how much? 25,000, right? So
Okay, okay.
yeah, same thing. You got the same answer, right? So that's the break-even point. Correct.
Mm.
So now let's proceed. Now I want to look at a pictorial representation of what we learned. Here we'll do a basic break-even chart and then we'll do a little bit higher level of charts. Okay. The basic chart shows the units on the x-axis always and the dollar on the y-axis always. Okay. Always dollar will be on the y-axis.
Yeah.
Now here they've given us a situation where the company is forecasting 1,700 units at 50. So total revenue will be 85,000 if you multiply these two. Okay. If you multiply this, you'll get a revenue of 85,000. The variable cost is forecasted to be 30. And if you multiply this, you'll get 51,000. 30 into
Mm.
700. Fixed cost is same. So 51 plus 20 will be 71. Total cost, right? Now, at this volume, right? Now, here in the chart, you can take fixed cost here as a flat line because it will be constant same. This is taken care of. And the total cost is 71,000 because I said 30 into 1,700 would be 51. 51 plus 20 is 71. So where does 71 come? 71 comes somewhere here, you see, 71. At 1,700 units, 71 comes here. This is the point, okay? This is the point. And for this point, you should connect this line, this point to which line? To this line, this fixed cost. See, even at a zero volume, you will have your cost to be 20,000. Yes or no?
Yeah. Yeah, yeah.
Then as the volume increases, you just connect the 2 points. Don't bother about anything. Just take this point, take this point. So now you got this total cost line. Your revenue
Mm.
starts at zero. At zero volume, the revenue is zero. At a volume of 1,700, your revenue is 85,000. So find the point, connect them. Now you get an area here which shows a loss that even if when you have no sales, there's a cost. So there's a loss area, right? As you start earning, like revenue starts happening, loss reduces. And at one point becomes zero. That's a break-even point. If you draw the line below here, you get 1,000 and then break-even point you get at, the 50,000. We just saw 50,000.
Mm.
I mean, no, sorry, this is a different question. So break-even point here happens at 50,000. Why? Because 1,000 into 50, right? No, 1,000 into 50 is 50,000.
50,000.
And beyond this point is revenue or profit because the sales is increased beyond total cost, profit area. So if you look at this 85 minus 71, you will get a profit of 14. Okay, 14.
Mm.
And the break-even point must be 14 plus fixed cost, 34. Because break-even will be at the,
Yes, yes, yes.
yeah, right? No, so this is what it is. And now they have given you all these breakups, and if you go do this, you will get the clarity here. Okay.
Yeah.
If you go to the next chart,
Yes.
keep going down. You got another chart, not this chart. I think
Profit volume chart.
no, before that, the contribution break-even chart. There is
This
a
one,
little
ma'am.
header. Just above, there's a header also. If you go above, slightly more higher, the contribution break-even chart. Okay. What happened
Yeah.
with this was, you see, the problem with this was that we started with the fixed cost and total cost, right? And then we
Mm.
had the sales over here. and the profit was here, and the fixed cost was here, the contribution was split. So instead of that, if we do this, we have the sales line here, which is acceptable, and we have
Okay.
a variable cost line. We make a variable cost line. Then the entire, this difference, variable cost, sales minus variable cost, this would be contribution, you know. So to
Mm.
show the contribution in one place, you could use this chart, right? So if you go to the next chart, you will
Yeah.
it'll look like this somewhat. See here, there is a variable
Uh,
line, there is a total revenue line, and there's also a total cost line. But now the clarity is what? This is the sales revenue, this is a variable cost. So this entire thing is contribution, you know, this entire thing is the contribution. Right now, this is the advantage of this. And you know that the in total cost line and this at 1700, this total cost line, if you draw this, then you get to know that, oh, out of the total contribution, this much is my profit, 14. And then if you subtract 71 and 51. Yeah, 71, 51, you'll get the fixed cost. Just a depiction, okay? The depiction changes a little bit. Like now, contribution lies in one place.
yeah.
Okay, now we'll go into the next chart. And you're going to do the work on your own, and I'll be there to clear your doubts. Go to the next chart.
Next chart, no?
Yeah.
The profit volume.
Yeah, here's a more interesting chart. They are saying that let's look at profit and at what volume, you know. Profit
Yeah.
is going to be, so here the figures will become negative also, you know, because profit at 0 is minus 20, the fixed cost.
Okay.
Yeah, right. So you have a point here. Then the profit at say 1700 is 14,000, right? So you have this point. You have 2 points here, right?
Mm.
And this is the volume. You just connect the two, you'll end up at 1,000. And 1,000 is what? 1,000 is the units at break even. See
Unit.
here there's no profit, no loss, right? Very
Yeah.
visible. So this is the beauty of it. So now I'm going to give you time to practice this now. And then we
Mm.
will continue with the multi-product break even, you know, later on, right? So can you start the practice now? Yeah.
Yes, ma'am. The charts, ma'am.
Here only now start doing from the very beginning. And
Okay.
there is this chart will give you some understanding, you know, like testing of your own understanding about the concept. Here it says, see, there are these two, what do you call, points given for situation. That means same company, two different situations. Are you getting that? Like, for example, let me explain this to you. Perhaps they are buying a slightly inferior machinery, and the fixed cost is 30,000 minus 30. Got this? Fixed cost. Are you with me? Perhaps a situation, this company has bought a slightly inferior machinery. The fixed cost is coming to minus 30. Maybe operator's cost, the fixed cost, everything, you know. And this is more superior one, it's almost like 45,000, right?
Yeah.
Now, if it is going to be like a slightly inferior machinery, the fixed cost will be lower, so probably it's breaking even a little faster, right? But then later on, it's not having any steep kind of a profit. The profit just flows like this. So slightly lower, right? Now the superior machine will take more time to break even. That's why the break even is shifted, right? Break even
Yeah.
point. And at one point, then beyond one particular point, it starts accelerating its, you know, profit. So this is
Mm.
what we see. This is a profit volume chart because the negative and the positive, right? And
Yeah.
at this point, at the, you know, this one now. So now, in the situation here, it says that a lower product specification will be used, resulting in lower selling price and production cost per unit. That's why you break even faster, perhaps. Lower production specification, so the machinery cost is lower and or fixed costs are lower. Situation be higher, right? And they've drawn a profit volume chart. Let's see what they're trying to ask us. They're saying something to us. What are we supposed to find out?
The contribution.
Based on this profit volume chart, the situation results in the higher contribution per unit higher contribution per unit always should be the steeper line like this. Remember this, like the steeper, than like this way, So
Yeah.
obviously, according to me, it should be situation B. And then also, this is because A has lower production cost per unit. B is selling higher selling price, higher contribution per unit situation.
There's no steeper slope.
But then the situation A has got, B has got steeper, no? B is steeper, no? If you look
Yes,
at,
ma'am.
yeah. So this is like more spread out. So um, at what sales will be in different, that is okay, clear. Now here, situation A has, they're talking about situation A has a lower production cost per unit, but I don't think so. And then situation B has a higher selling price. Situation A has uh, a lower break-even point. Obviously, situation A has got a higher break-even point, is it not?
Hmm.
Situation A has got a lower break-even point. Okay, fine. Situation A has got a lower break-even point. Now, situation B has a higher selling price. A higher selling price automatically will that give you a higher contribution? I do think so. This can be true. The higher selling price can give you, but higher selling price and higher production cost could have been a problem then,
Yeah.
correct. So they're talking about two situations. A has a lower production cost per unit. How can we find that out? That A has a lower production cost per unit? You're not able to find that out. From this chart, we cannot find out whether A has a lower production cost,
Yeah.
right? So what we'll do is now the graph depicts clearly the larger profit available from situation B. It also shows that the break-even point increases from 20 to 22,000, but this is not a large increase when viewed in the context of the projected sales volume. It's possible to see that for sales volume above 30,000, the profit actually will be higher in situation B. We saw that. For sales
Hmm.
volume below, situation A would be better. Correct. Now specific. Situation B has a higher contribution. This cannot be deduced from the difference in selling price or cost. For example, this question is not a complete question, just made you think, That's why having a higher selling price should have been the answer, but higher selling price can also be combined with higher variable cost. Then you cannot give any answer. Having a high selling price would normally lead to high contribution, but only if the costs remain the same. If selling price and cost change, then it is difficult to determine what will happen, right? This rules out the option A and B in the next part of the question. Next part. It cannot be reduced from the different break-even point as this is influenced by the level of fixed costs for what? So we cannot even deduce from the different break-even point as this is influenced by the level of fixed cost for each option. This rules out option C. So
Yeah.
the fact that situation B has a steeper slope indicates that as volume increases, the profit is increasing at a higher rate. This would indicate that situation B has a higher contribution per unit. So that is what we need to look at, that the fact that it's getting the only answer we can deduce from this, is that at least one thing is clear that situation B has a steeper, than compared to situation A. Like,
Yeah.
produce it like something like if I'm producing a graph, something like this. Okay, it has to be a little different. But so here's steeper, right? That's the only situation. That's the only reason why we would say that situation B must definitely be having a higher contribution. That's your
Hmm.
answer.
Yeah.
For the final question, the point of indifference, that's clear, right? So this
Yeah.
was a question to test your understanding about that chart and the, like logic, applying the logic. Like with this picture shows what really the steeper one shows that contribution higher. See, the reason is because if the contribution is not higher, it's going to take forever and ever to break even like this way. But some things where, at start at the same point, fixed cost may be same, but it could just, have higher contribution. Fixed cost being same, per unit, the contribution is going faster and faster to accelerate your, reaching the profit part, right? So you reach
Yeah.
break even here and you start making profit, right?
Yeah.
With the multi-product break even, right? So meanwhile, practice
Yeah.
this and come back with doubts for me.
Sure, ma'am.
Thank you.